welcome to this week's MFB news. I hope you're very, very well and that you are able to get out and enjoy this absolutely incredible weather. I have to be honest, the days where the weather is like this, it makes working in an office or in my office feels slightly more like punishment than normal, but actually hopefully it will continue into the weekend and we'll get to enjoy a bit of it at some point throughout the week. Now, in terms of what we're going to be covering off for you this week, it feels like not only are things hotting up in terms of the weather, but actually the mortgage market is seeing some improvements and things are feeling slightly sunnier there as well. So we'll come on to that in a moment. We're going to be talking about lender pricing changes. We're going to be talking about lender criteria changes. We're going to be talking about rents in the private rental sector. We're going to chat a bit about consumer confidence in terms of the economy. And then finally, we're going to be just covering off a couple of things that have come out from Labour in terms of their plans for the private rental sector should they be elected in July. Okay, so let's talk about swap rates. But before we do that, let's just rewind slightly to what's been happening in the last week, because it has been quite a busy old week. So first of all, we had the inflation data which was released, which told us that inflation had now come down to 2%, which is indeed good news. And this has been really helped mainly by easing food inflation, with food and drink prices falling month on month, which is really, really encouraging. However, core inflation has also come down to 3.5%, but there is still wage growth and service inflation, which are running very, very hot. So wage growth is 5.8% and service inflation is 5.7%. And this is proving to be quite worrying. And this is probably contributing to the reason why the MPC did not choose to reduce the base rate in the month of June. Now, the kind of thoughts about it coming down in August are also very sort of mixed at the moment. My personal opinion is that it's quite unlikely we're going to see a base rate reduction in August, but let's just wait and see. Now, in terms of how that's filtered through to the swap rates, the news seems to have been received quite well, and things do have come down a bit. So in terms of your 2-year swap rates, 4.415 as of 10:30 last night, and by comparison, 1 month ago, 4.676, and 1 year ago, 5.725. So in terms of year on year, we are 1.3% cheaper on 2-year fixed rates than we were. And actually month on month, we're also circa 0.25% lower. So that's a real improvement. Now, in terms of 5-year fixed rates, very, very similar story. As of 10:30 last night, 5-year swaps were at 3.858. 1 month ago, 4.102, and 1 year ago, 4.868. So year on year, 5-year swaps are down by around 1%. Now, in terms of how this has impacted lender pricing, so actually what we find is that there's lots of lenders these days. Lenders are able to reprice, or some lenders are able to reprice their product sets really quite quickly because it's all done on systems. You just key in some numbers and it kind of spits it out. They have to go through some treasury changes, but actually it's a lot more straightforward than it used to be, where everything was done in a much more manual fashion. So some lenders are able to react to changes in cost of funds uber quickly, and we've witnessed that when they've gone up. And the good news is that despite some of us being somewhat cynical around mortgage lenders, actually they are looking to pass on their cost in, or saving in cost of funds to borrowers where they possibly can. And so to this end, we have seen a flurry of repricing. So we've seen Precise Mortgages bring their rates down. Their rates are now from 4.89%. Kensington have reduced their limited edition rates. So theirs are now from, on 2 years, from 4.19 and 5 years from 5.09%. We've seen Fleet make reductions to their range of up to 0.3%. And they've also added some flat arrangement fee products, which their product set was missing previously. So their pricing now is from 5.09%. We've seen Landlords reduce rates by up to 0.1%. So their rates are from 4.49 on 2-year fixes and 4.59 on 5-year fixes. Just be aware that these Landlords rates I'm giving you just now, where they start from, have massive fees. They do have rates which are higher with lower fees as well. And Keystone have reduced their rates by 0.15, so their rates are now from 4.29, again, slightly higher arrangement fees at that level. And Molo finally have reduced rates from so their rates are now from 4.55%. And they're all the kind of specialist lenders. So these are lenders who, and I'm sure you guys are very, very aware of this by now. So things like limited companies, no maximum number of properties in the background, no minimum income requirement, HMOs and multi-units as well, layered companies, day one remortgages, all that kind of slightly more niche stuff. All of these are lenders who are largely exposed to the money markets, and that's why you would have seen their funding costs come down. They've been able to make reductions really, really rapidly. Now, in the terms of the more kind of high street lenders, we have actually seen a couple of changes there, and not insignificant ones indeed. So BM Solutions have reduced some of their rates by up to 0.5%, and Virgin have also reduced some of their rates by up to 0.3%. Now, these are both lenders who actually had priced up quite recently. So I suspect that their ability to reduce rates is possibly partly due to how their cost of funding has worked, but also I suspect that actually they'd kind of priced up, and because of that increase quite recently, they've given them room to essentially come back down again. So really, really positive news in terms of lender pricing changes. And I think if swap rates continue to be kind of where they are, because they are circa, if we look at the previous week, 0.1% lower, 0.15 maybe to the week before that as well. So things have eased off slightly. So I do suspect that we'll have room for more lenders to reduce rates in the coming weeks. So obviously we'll keep you updated. Now, not just a busy week on pricing changes, but also a fairly busy week on criteria changes, which is always nice to see. Now, the first thing we've seen is that the Skipton, or as some people who work for them affectionately refer to it, Skippy, have reduced their window for product switches. So what this means is that in the good old days, as it were, if you wanted to apply for a product switch, most lenders wouldn't let you apply until you were circa 3 months. Sometimes it's done in days or weeks, but circa 3 months from the date of your fixed rate ending. And what some lenders have done is, because of the volatility in the market and because people were sort of feeling very anxious, some of them increased that window to 6 months. So essentially 6 months before your rate was due to end, they would open up the pricing for you and you could book a rate for a product transfer. And this has been really, really helpful for borrowers actually, because what lenders do let you do, and they don't shout about this, but what they will let you do is cancel the product transfer, generally up to a month before it clicks in, sometimes even closer, cancel it and go again. So if you booked a rate 6 months in advance, rates came down, you would simply cancel it and start again and get a new product which was lower. So that worked really, really well for lots of borrowers, and the lenders are to be commended for allowing them to do this. Now, what the Skipton have done is actually reduce this back down to 3 months now, and I suspect their reasoning for doing this is actually it just doesn't need to be available for 6 months, because actually if interest rates do continue on the direction of travel that they're on, then the rates will be coming down. And actually, while lenders do allow this facility to cancel a product application and restart it again later, from a kind of management of their funding, it's an absolute nightmare. So it's not something they really want to be doing, but they've allowed it to happen to kind of help out borrowers. So keep your eye on that one, because I suspect that the Skipton won't be the only lender to make a change of this nature. Now, Zephyr Home Loans have released some 80% loan to value rates on HMOs and multi-units. So they didn't have 80% products on those before, so they've brought that back into the market. So that's really fantastic. Shawbrook have now changed their policy to accept first-time landlords on smaller multi-units, so up to 6 self-contained units. They've also increased their maximum loan to value on industrial properties in their commercial lending space to 75% loan to value, and they've also increased their max loan size from 500k to 1 million for bridging finance for refurbs, with a maximum loan to GDV is increasing from 65 to 75% loan to value, so a real expansion on their criteria there. And the final one that we've had come through, which I found really interesting, this is the one that I particularly wanted to focus on this week actually, was from Foundation Home Loans. Now, Foundation are a specialist buy-to-let lender who have really kind of tried to investigate how they can assist the market, assist borrowers in the areas where there is kind of simply not enough support in terms of mortgages. So things like really large HMOs and multi-units, expats, that kind of thing. But one of the things they've also recently gone into is semi-commercial properties. So with semi-commercial, essentially what you have is a mixture of residential and commercial on one legal title. And the obvious example of this would be a shop with a flat above. That's the one our kind of minds all spring to. And they are able to consider this. Now, the pricing on a semi-commercial property would be more expensive than a buy-to-let mortgage, but actually there's some bits in their underwriting which makes it probably slightly less laborious, shall we say, to apply for than if you're applying to a commercial lender. So if you're someone who's in need of a semi-commercial mortgage and actually you don't have months and months to wait before you need the mortgage to complete, this could be a very good option for you. Now, in terms of criteria, so essentially in terms of the valuation, and while they're looking at the overall property of the value, the residential element has to be accountable for around 60% or more of the overall value of the property. So if the property is worth in total £200,000, the residential part needs to be worth at least £120,000. Maximum of 70% loan to value. Now, one of the things they do here that I really like is they can consider all properties if on one freehold title with resi above, and the commercial part is something where they wouldn't necessarily ordinarily lend if they were just lending on the residential element. So for example, if the ground floor was a takeaway, a restaurant, a bar, betting shop, hairdressers, that kind of thing. So whilst they wouldn't necessarily lend if it was a leasehold flat above one of those types of commercials, if the freehold contains that kind of tenant, then actually they can consider lending, which I know is a bit ironic. Who are we to argue? Maximum loan £3 million. They will lend to first-time landlords, but not first-time buyers. They can do day one refinancing as well. So lots of really good things there in their semi-commercial offering. And we are certainly seeing landlords kind of reinvestigating their investment options to try and make sure their portfolio is running as well as possible. And semi-commercial is definitely something that some landlords are certainly looking at in more detail at the moment. Okay, now quickly just to touch on how rents are performing, and still things are increasing. So the average private rent in the UK rose 8.7% annually in May to £1,262 per month. This is according to data from the ONS. Now this is down from the growth in the previous year-on-year comparison, which was 8.9%. So the rate of growth of rent is slowing down, but it is still growing nonetheless. So compared to last year, the average rental cost across Great Britain, so it's now £101 higher. Now this marked the second month in a row that rent inflation has slowed in England, coming down from 8.9% increase in April and a record 9.1% in March. The average rent in Wales rose annually 8.5%, or by £58 to £736 in May. This was higher than the 8.2% recorded in April. However, this was more modest than the record higher annual rise of 9.8% in November. The ONS said the annual inflation rate for Wales had been decelerating ever since then. Now, average rents in Scotland were up by 9.3%, in Northern Ireland 10.3%, so things are still increasing there. And within England, the highest rent increase in the year to May was recorded in London at 10.1%, bringing average rents to £2,086. Now this was down from the rise of 10.8% the month before, and below the record high of 11.2% in March. The North East saw the lowest rise in average rents, with a 6.1% increase to £667. Now, interestingly, detached properties attracted the highest rent in May at £1,461, while flats and maisonettes were the lowest at £1,228. I say interestingly, that's not that interesting. You'd expect a detached house to get more rent than a flat. The average average private rent was highest for homes with 4 or more bedrooms at £1,932, while one bedroom properties averaged £1,009. There you go. In terms of the rental sector performance, we are expecting rents to continue to increase over the coming 12 months, but actually we are still expecting the rate of that to continue to slow. Okay, now despite all the noise that's going on with the election and inflation, although I appreciate that's obviously now going very much in the right direction, and also interest rates and this kind of stuff, there's some very, very good news that consumers are increasingly optimistic about the economy. So consumer confidence has seen a third consecutive monthly rise since March, and this is according to a survey by GfK, which is a long-standing consumer confidence index. The report this month climbed 3 points in June, reaching -14, and this increase was driven by growing optimism about the economy, with a 7-point boost in confidence regarding the general economic situation over the past 12 months, and a 6-point surge in expectations for the economy in the coming year. The major purchase index, which measures confidence in buying big ticket items, also rose 3 points. However, the forecast for personal finances over the next 12 months dipped 3 points to a +4, although this does represent a 5-point year-on-year improvement. So one of the directors at GfK commented that once again we've seen an improved reading for the overall index score, with June showing a 3-point improvement, bolstered by consumers' more sympathetic view of the economy for the last year and the 12 months to come. Now, why is this important? Essentially, if people are not feeling confident about things, they stop spending money, they stop transacting on house purchases, this kind of stuff. So actually a growing confidence in the consumer market really kind of earmarks a kind of sign of how things may be going forwards. And from our perspective, where we need to kind of think about that is the housing market. And actually what we could see is more people start to consider buying and selling. Okay, now just moving on to all matters election. Labour have made some comments in the last week which we wanted to share with you because they have stepped up their programme clamping down on what they're calling unscrupulous landlords strangling growth. So what this actually means is that they're going to be ending bidding wars, capping upfront payments to secure properties and requiring all landlords to make their properties EPC of C or above by 2030. Now let's just look back a moment. So last autumn, Rishi Sunak ditched the EPC targets for the private rental sector, citing unreasonable costs for landlords, but it looks like Labour will be very keen to bring that back in within the next 5 years or so. So essentially what this means, so first of all, private landlords would no longer be able to auction rented homes to the highest bidder, and requests for upfront rent will be capped, although it's not clear at what level. This is in addition to the existing comments on Section 21 being abolished and other rental regulations. Now, in terms of how this is going to go down with landlords, I mean, I can't imagine on any level this is going to go down well, unfortunately, particularly when you hear comments from Angela Rayner saying that time and time again the Tories have failed to stand up for renters, from endless delays to no-fault evictions to failure to sort damp, cold and mouldy homes. The Conservatives have been failing the working people. Labour will call time on a decade of Tory vested interest and put renters first. An affordable, secure private rental sector is vital for economic growth, allowing young people to save for a mortgage with more money in their pockets to spend in the day-to-day economy. Our plans will support good landlords, but we are calling time on unscrupulous landlords strangling growth. So there you go. So I think the good news is that I'm sure all of you are very good landlords. I don't think anyone sets out to be a bad landlord. So I suspect that if Angela Rayner is speaking the truth, then their plans are going to be to support all of us, and we've got nothing to worry about. Let's just hope we're right on that point. Goodness me, the sun's coming round, isn't it? And I'm going to be blinding you. So we're going to wrap it up for this week. So yeah, as always, thank you for watching. Hope it was helpful. And if you have any questions, you know you're always very, very welcome to give us a call. We'd love to have a chat with you. 0345 345 6788. Yeah, so let's hope that next week brings us news of some more reduced interest rates. I think at the moment that's the kind of thing we're all hoping for. And we'll obviously update you with any further updates in terms of the election. So until then, look after yourselves, keep cool, don't get sunburnt like I did at the weekend, and I will see you same time again next week.